Hi, welcome back to my channel. This is Ben Morales, and we are going to continue with the series all about lines of credit. This is the time of year where a lot of people incur a lot of extra debt, and they're going to start making plans to get out of that debt in 2025. So, before you do that, I just want you to watch this video and really know what you're getting into before you go to a bank or some other institution and ask for a loan. So, let's do a quick comparison. We're going to find out why a line of credit is actually a better tool for you, especially if you're going to be trying to pay off debt quickly and efficiently. So, what is a loan? Well, in a nutshell, or rather, where do you go to get a loan? You're going to go to either a bank, credit union, or online services. You could actually get one there. So, when you're going to get a loan, keep in mind you're going to get set terms. Those terms are typically 1 to 5 years. All right. Now, the loan amount that you're going to get is typically, as I've been doing my research, I'm putting a resource guide together. If you would like information, or when I complete that resource guide, if you would like to have that, please let me know in the comments below. And basically, what the resource guide is going to be is a list of banks, credit unions, online services that are offering the lowest rates when it comes to loans and lines of credits and things like that, so that you can make an informed and educated decision before you actually buy a bank product. So let me know if you need that. But the loan amounts will be anywhere between $1,000 to $35,000. And then the interest rates, what I've been finding as I'm doing my research, the interest rates are anywhere between 12 and 7.89%. So typically with a loan, keep in mind, the more you ask for, then the lower your interest rate is going to be, right? Because the bank's purpose is to lend money, and they want to make as much money off of you by the amount that you're going to lend and over the time that you're going to have that loan with them. So typically the lower that you ask, right, and you borrow less, you're going to have a higher interest rate. The more that you borrow, your interest rate should be lower. And that's why you see the interest, the gap or the difference in interest rates. And that's based heavily on the amount and the loan term. And then the last thing is a loan, keep in mind, is close-ended, right? So what happens to your cash flow when you borrow a loan? Well, your cash flow is going only one way. You make a payment, never see that cash flow again, right? You're sending a money into the hole. I did a video about that. Every time you send cash flow to make a payment on a loan, that money is gone. If you want the money again, what do you have to do? You have to go back to the bank and ask, can you please give me my money back in the term of a loan? And they'll say, sure, let's see if you qualify. Absolutely, we'll help you with that. So now let's go into a personal line of credit. Well, same thing, right? We go to apply a personal line of credit at banks, credit unions, and online. But where it differs a lot from a loan, right? That's probably the only place where a line of credit and a loan have similarities. Everything else is pretty much different. So lines of credits have a draw period, okay? And I'm really focusing here on a personal line of credit. So as I've been doing research, I've been finding out that a lot of the banks or the institutions that offer lines of credit, they do it on a draw period basis, but that draw period can have a limit. And I've seen it as low as 3 years and 5 years as well. What that means is that line of credit will be there for you to use, okay, for 5 years. That draw period, you can use it for 5 years, you can use it for 3 years, and then it drops off and you can't use it anymore. If you need to use funds after that time period, you have to go and reapply again with that institution. So when you're out there shopping, right, we talked about it, you're getting ready to pay off that credit card bills or that debt, look for loans or lines of credit rather that are continuous, right? That line of credit is always going to be available at your disposal. That's the type of line of credit you want to focus on. So as you're making phone calls out to lending institutions, credit unions, or banks, that's one of the questions that you want to ask them. Make sure that that line of credit is continuous, okay? Most of the continuous lines of credit, they have a small fee, maybe 50, 65 bucks, something like that. But it's better to have that at your disposal, okay? We're going to see why a little later. So the lines amounts, not loan amounts, but the line amounts I have found have been between $1,000 and $25,000 with interest rates as high as 15%. Obviously, I'm sure there's other banking institutions that will do it at a higher rate, but I don't like to go past 15%. I would recommend that if you're being offered a line of credit at 15%, look elsewhere for that, okay? So I've seen low rates as low as 9.49%. And those rates are based heavily on your credit score. So that's the difference between a line of credit and a loan. The interest rate is based off the term and the amount that you want to borrow. And a line of credit is heavily based off of your credit score, right? Because it is an unsecured loan, or line rather, I should say. It's an unsecured. So the bank is going to really make sure that you have high credit score, sometimes north of 740. Some might go as high as 780. What I found in doing my research is if you want higher amounts, 25, 30,000, then you're going to have credit scores north of 800. So keep that in mind as well. And then this is the beauty of lines of credit, is they are open-ended and they are revolving, right? So your cash flow comes back to you. There's your cash. You go into the line of credit, you draw from it, you use it, you make a payment, that cash again is available for you. So that's the great benefit of using a personal line of credit over a loan. So the video is called "Why Are They Better Than Loans?" Well, I can think of at least three things, and we'll notate them. So number one, lines of credit, you pay interest at the end of the day. So some of you are thinking, what do you mean I pay interest at the end of the day? Well, keep in mind, a loan, the way a loan is calculated, the payments of the interest is calculated with the loan, that is amortized. Meaning what? When you send a payment, let's say it's a $200 payment, you're sending that payment to the bank for that loan. The bank is taking the interest amount of that payment first. They're taking that payment or that portion of the payment out first, right? That's how they make money. They have to lend. So once they take that interest amount out of your payment, the remaining goes toward your principal paying down that loan. That happens up front. That is one of the challenges, and that's the problems why discourage people not to get loans, because they're front loaded. Okay. A line of credit, you pay the interest at the end of the day. What does that mean? Well, lines of credit, the interest are the what you pay in interest is based off of average daily balance, right? I've talked about that before, meaning that the bank has to wait until the close of business day to determine what was your balance for that particular day. And then your interest is calculated on a daily basis, right? So they have to do that every single day so that they can use their formula to calculate how much they are going to charge you that month on a per day basis for your interest. So essentially, as you're making payments back toward your line of credit, you could actually make a payment every single day for 30 days on your line of credit and really, really cut away at the interest cost that you're going to be paying. And that's one of the great advantages of utilizing a line of credit over a loan. You pay interest at the end of the day. Point number two, or the second reason rather, I should say, is because your financial situation may change. Okay, so when it does, and I remember being at the bank, it was always a sad thing when a lot of people would come to the bank. They were looking for money, home expenses or home repairs, Christmas, right? Helping the kids through school, to buy books, different things, that day-to-day expenses, things that show up. They will come to the bank. Someone lost a job. They didn't have the funds coming in anymore. They didn't have. They only had part-time payment. It could be different reasons why they weren't able to get a loan. Well, it's whether those situations are present, it's more difficult for you to get approved for a loan. So because your financial situation may change, you might go from a two-income family down to one. What will happen is it becomes more difficult for you to get a loan or line of credit. So the best time to have a line of credit is yesterday. If you are in the position to be able to qualify for a line of credit, take advantage and apply for a line of credit and get that process going, because a line of credit, you will only pay interest on the portion that you use, okay? And it's always available for you. That's a big difference. Remember, we talked about that money being able to go in, use it, draw from it, and then pay it off. That's one of the great advantages as a line of credit. When it comes to a loan, you may end up getting a loan for a project. Let's say you're doing a home repair. You think that home repair is going to be $8,000, or oftentimes you get quoted under, and then you need to go back because you need more money, or the opposite might be true. You might think it's going to be an $8,000 furnace or heating repair, and you actually get it done for $6,000, but you're paying interest on the $8,000. Okay, line of credit gives you a lot more flexibility, so keep that in mind. And then item number 3 is a line of credit. You can use it to implement the velocity banking strategy, okay? Because it becomes a debt tool. And velocity banking is one of the things that I teach here. So velocity banking is a strategy that will more quickly and efficiently help you pay off debt. So you can use a line of credit to do exactly that. So I hope this information helps you. I know I went through it. These are just some of the benefits of many other benefits as well. But in my opinion, and how I've used lines of credit for my benefit in my life, and after the 20 years of working in the bank and seeing really, loans are really not the answer to helping the people to pay off debt. It's not the way to go. You want to focus on lines of credit. So I'm here teaching you this information so that it can have a positive impact in your life. So with that, I just want to say thank you for your time and for your support. Continue to like, share, comment, and subscribe. Especially if you're looking for that resource that I'm putting together, I would be more than happy to share that with you. If you have any more comments or concerns, my contact information is below. Please reach out to me and I'll be sure to help you out in any which way I can. So thanks again for your time.